Responsibility Accounting Part 1, Lesson 1.1 for S-Command 2. Responsibility accounting is a system that recognizes various decision centers throughout an organization and traces costs such as revenues, assets, and liabilities where pertinent by areas of responsibility. This system is also known as activity accounting and profitability accounting. It operates on the premise that managers should be held responsible for their performance, the activities of the subordinates, and all activities within their responsibility center. Simply, the responsibility accounting is used to determine the performances of each manager in every responsibility centers. Talking about responsibility centers, we have four different responsibility centers. We have the cost center, the revenue center, the profit center, and the investment center. Let's discuss first the cost center. Once we talk about cost centers, these are centers where managers are held responsible for the cost incurred by the segment or by the responsibility center. While the revenue center, managers are held responsible primarily for the revenues only of the segment, but not the cost of the generating revenues. The manager's performance is measured in terms of revenues earned. Some of the bases include the ROI, the profit margin, the ROA, and among others. Okay? While the profit center, where managers are held responsible for both revenue and cost of the segment. Kasi profit nga, well, take note when we say profit, profit is determined by using the revenues earned and the costs incurred. So after deducting the cost incurred from the revenues earned, that will be the profit. So that's why that's the profit center focus or responsible for both revenues and cost. While investment center, where managers are held responsible for revenues, cost, at the same time investments. Okay? So we have already understand the different type of responsibility centers. Let's proceed to the performance evaluation tools. For this material or PowerPoint presentation, we will focus on the first performance evaluation tool, which is known to be the return on investment. We cannot deny the fact that we have learned this before on our previous subjects, particularly on financial management subject. Okay, return on investment. A short recap. Remember, the return on investment is calculated as operating income divided by operating assets, or it can be computed by multiplying operating profit margin to the operating asset turnover. And then, or we can compute the ROI using the DuPont formula. Yung kaninang sinasabi natin, the operating profit margin multiply the operating asset turnover is already the DuPont formula. To expound that, that is return on assets is equals to turnover times return on sales. Wherein the return on asset is equals to the net income over assets, while the asset turnover is equal to sales over assets, and the return on sales is the net income over sales. Why is that so? Using the return on asset, no, we can compute the ROI. Okay, simple. If we're going to check this, no, if we will simplify the DuPont formula, net income over asset is the ROA. The sales over asset is what we called again the asset turnover, while the net income over sale is what we called the return on sale. The denominator on return on sale is sales, while the numerator on asset turnover is sales. If we're going to eliminate the numerator, okay, numerator for asset turnover and eliminate the denominator on return on sales. As a result, that will be net income over asset, which is the ROI. Okay? So, example, total assets of the ABC company is 750,000, and then we are also provided the computation of net income for the current year. Okay, as we observe, the net income for the current year is 45,000 pesos. We have sales of 500,000 pesos. Okay, later on, we will use those information in determining the ROI. If we're going to use the first formula, the simple formula, ROI is equals to net income over operating asset. That is simply 45,000 divided by 750,000. The ROI is equal to 6%. But if you're going to use your calculator, it will be happen to be 0.06. Naging 6% siya because I multiply it by 100%. If we are going to use the DuPont formula, that would be ROI is equals to 500,000, which is the total sales based on the income statement provided, over 750,000, which is the total assets of the company, multiplied by 45,000 pesos, which is the operating income of the company, over the 500,000 pesos, which is sales. And then if we're going to simplify that, the the asset turnover is 0.66667, while the return on sale is 0.09. If we're going to multiply themselves, we will come up with 0.060003, or simply that is 6%, equivalent to what we have computed previously. Question, what is the indication of computing the ROI? Return on investment, we cannot deny the fact that the return on investment is an evaluation tool that determines the performance of a particular segment or entity, particularly revenue segment, as what we have discussed or what I have imparted to you earlier. Well, if the ROI is positive, meaning it's above 0%, okay? The company's profit are more than the amount invested. That is good. Ibig sabihin po nun, we are earning above our investment. And then, management accountants use ROI to determine whether increase the profits or decrease the operating assets in order to achieve a higher positive ROI. So, ibig sabihin, pag if you are a management accountant and then you determine that your ROI, proposed ROI after the current year was not achieved, it will be determined that the performance of that particular segment is not quite good because it wasn't able to achieve the ROI you are targeting. But we cannot say that you're not good, hindi lang talaga siya na-achieve. Okay? So for today, that ends our discussion. Thank you and God bless.